Hey everyone, I've got some really interesting data this week. I love looking at where things are at and where things are going so we can get a feel for what's likely to happen in the real estate market. Obviously, in the mortgage business, I buy real estate, something I really want to pay attention to. And if mortgage delinquencies are spiking 128%, which they are, that is something that we need to pay attention to. We already did a video last week that I'll link to covering inventory being up to levels that we haven't seen since 2016 and my thoughts on that. And then we also are going to look a little bit at credit card debt and see how that's all doing. I also want to cover a very interesting article really going over what is likely to happen in the mortgage market between now, between now to the end of the year and next year, and kind of get a feel for that as well. Hey everyone, this is Rayce Robinson, your favorite Florida mortgage broker. And let's start by looking at, there's been some articles dropped. This is National Mortgage Professional talking about note spike in delinquencies while foreclosures remain low. There's tons of videos on YouTube talking about mortgage delinquency spike. And that's important because they are spiking, right? 128% is a real number. So in 2021, they were at 1.4%. Fast forward to quarter one of 2024, they were at 3.2%. That is a 128% increase. And that trend is not good. So when I look at data, I look at two things. There's the headline that gets people to click on an ad, but most people don't read very far in. And then two, how do I know if that trend matters? The trend getting worse matters, but are we at a level that we need to worry about? And so a good question to ask is compared to what? So we want to know the baseline. What are mortgage delinquencies typically run on the baseline? And they run about 3.5% historically. So why is that important? Because even though mortgage delinquencies are going up, they're still below the baseline of 3.5%. You can see mortgage delinquencies spiking obviously in 2008, 9, and 10, and then going back to the baseline. And just to give you an idea of, where we're at as far as to the Great Recession, because that's one of the big events in my lifetime, mortgage delinquencies then were almost 29%. So we are at 3.2%, long way from there. But it is important to notice that the trend is going the wrong direction. A couple other things, credit cards in 2022 were at 4.1%. Today they're at 8.9%. The average is 6.2, which means, no surprise, I think that we're all kind of living in a world where the data, the press says one thing and then our reality is another. Inflation's higher, unemployment, I think when you look at the real data, is a little worse than what they're saying. And you have people using their credit cards to get by and then obviously getting behind, and that 8.9% compared to the 6.2 is starting to reflect people getting in financial trouble. Then you do have mortgage delinquencies going up to 3.2%. up from where it was at. So that's another trend. And then I also looked at auto loans, which are currently delinquent at 7.9%, where the historical average is 7.2. So those are things that we want to pay attention to. Those are things the Fed is paying attention to determine, are they going to cut the Fed funds rate? Are they going to keep it where it's at? So looking at rates, since this is a look at the mortgage market and real estate market, we are at 6.86%. Remember, everyone's rate's different. Your rate might be different based on credit score, down payment, loan type, a lot of different factors. But I like to look at the trend. And again, we have held below, and this is the important part to me, 7%. We have not been able to stay below 7%. Now, this is a fairly new development, but I think when you look at the Fed and what they're saying, that it is likely to go lower before it will ever go higher again. It's not going to go higher, in my opinion, unless there's some black swan event or inflation really starts ticking back up. So we shall see. But right now, the market really expecting the Fed to lower the Fed funds rate. Now, let me just mention a thing with data. I'm going to link to a YouTube video that I watched with a local Central Florida real estate agent. It's got a way bigger channel than I do. And he looked at the same data I did and comes up with a completely different take. His take is, and he's being interviewed, that you could see a price correction of anywhere from 10, and I think the other guy said to almost 15 or 20%. Now, people have been saying that for a long time. I personally agree with the data they're looking at. I just don't agree what their outcome is. And we shall see, right? There's no one to know. That is one of the things I will say after looking at data, going through the Great Recession, no one really knows what can happen. No one can predict the future. So it's all just, you should do your own research, listen to me, listen to other people, get other points of view on what they think that's likely happened to the market. But where I think they're missing in their analysis is two things. One, I do think rates being lower will move the market forward. Two, you have the sellers with tons of equity that are not going to get in financial trouble where they're going to be dumping houses like they did before. They may take their house off the market. They've got really low rates. They're not in financial trouble. And then lastly, the government is likely to intervene. If we started getting, a lot of mortgage delinquencies, they're going to start lowering the Fed funds rate, coming out with programs. So I think those things, why all these other companies, these national companies are predicting modest house appreciation over the next 5 years, it's not a conspiracy. They just see that same data that there's not a lot of sellers that are going to likely find themselves in financial problems. But keep that in mind that people will get in financial trouble. People will have to sell, but it only matters on a huge scale to really impact the market. And we are at about 10,700 homes. Great Recession was at, almost 30,000 homes. So if we get enough inventory on the market, rates stay high, demand stays low, then we will actually get some kind of price correction. We shall see. My opinion is we will get a fairly flat market through the rest of 2024. So this is the article I wanted to look at, where the mortgage market heads from here, according to Loan Depot's chief investment officer. And I'll point out something he says right from the beginning. Since mid-2022, the U.S. mortgage has experienced one of the biggest downturns in history, which a lot of people don't understand just how far demand has fallen off. So I want to look at a couple of things they talk about here. So one, how would you describe the mortgage industry and the housing market over the past 2 years since we came out of the housing boom and entered into this mortgage rate shock period, meaning rates getting almost up to 8%? And obviously, home buyers and affordability have been really pushing more and more buyers on the sideline. But on the other hand, and this is key, American homeowners hold a record $32.7 trillion in home equity. And of those who still are paying a mortgage, and last week I covered almost 40% of people on primary residence have no mortgage. That's one of the highest in history. 63% carry an interest rate below 4%. And to show you how much that's impacted the market, this is the Mortgage Purchase Application Index. It shows how many people are applying for a mortgage. And look how low we are. Right? That is mind-boggling to me that we have fallen that low on mortgage purchase applications. Now remember, every market's different. When you look at data, it's really hard to talk about even Florida. I live in Oviedo. I talked to an agent yesterday who put a house in Winter Springs, which is an area near us, and in less than a day, she had 20 offers, 3 or 4 cash offers. And in this market, if you price the house right, you are going to get a lot of activity. But there are places in Florida that are slower. In general, all places in Florida are getting more inventory, but you have to know your market. That is the advantage if you're a buyer partnering with the realtor, because they can show you the stats and numbers of what's going on in the market. So you're not underbidding houses. And look, if you're in an area that has, lots of inventory, heck, write disrespectful offers. If they've been on the market for 90 days, then go for it. But if you're in a market here like in Oviedo and parts of Central Florida, you're just never going to get your offer accepted. And to show how low this is, existing home sales have now fallen to 3.8 million, close to 3.9 million. At the same time, median home sales price just continuing to move up, right? And we're still seeing 2 to 3% appreciation here in where we're at in Central Florida and Seminole County. It's been closer to 4 to 5%. Then I like this last question here. This is that same article. How do you expect housing market and the mortgage industry to respond if mortgage rates fall? And they talk about more buyers that will get off the sidelines. However, this demand will continue to strain existing inventory. And the FHFA proposed this Freddie Mac potential way for homeowners to access their equity. I did another video on that I'll link to, which they're talking about. This is more likely to be a home equity driven refinance boom, the next one, because if you have people getting behind on credit card debt and all these things, what are they going to do? They're going to tap into their home equity where they've had this massive growth, but they really can't access it. If second mortgages became more reasonable in cost, you would see more and more people tapping into that. Do I think that's a good or bad thing? I know I always get some hate comments when I talk about this. Of course, it's bad to tap into your equity if you don't need to. But if you've got a ton of equity and you got a ton of revolving debt that is pulling you under, and you put that into long-term debt, and then you don't turn around and run your, your all your revolving debt back up, then it works out to be a good thing. Where the issue is a lot of people use their house as a cash register. They run the revolving debt back up, and then that does create a problem. So we'll see. At the end of the day, that hasn't came out yet. I do think that rates are on their way down. Just one last quick here from the rate probability tracker that I look at. 93% chance they're not going to cut this next meeting. But when you get to the next meeting after that in September, 88%. So what would I do with all this information? Here's the number one thing I would stress. I have 3 kids. One's a homeowner, 2 are in school. Don't try to time the real estate market. Can the real estate market soften up over this winter? For sure. Winter's typically a slower time. Let's say the Fed doesn't cut rates, which is definitely possible, right? I actually kind of wish they would hold on to higher rates, even though it's not great for my industry, but I don't think housing prices need any more gasoline poured on them. And if you keep lowering rates, that will tend to happen. At the same time, if you're a homeowner, or if you want to be a homeowner, you can afford it, you qualify, you've got the reserves, and you're going to be in a house for 3, 4, 5 years. The real estate market's undefeated for building wealth. And if you take a long-term view and you qualify and you can afford it and you have reserves, you're never going to look back and say you're sorry. At least that's my opinion. Again, don't get your financial advice from me. I'm heavily involved in the real estate market, and it's paid off in a big way over the years. I think it will pay off for you as well. If you have any questions on this, any of the data, we're going to keep looking. Days on market, inventory, what the Fed's doing, mortgage delinquencies, so we can get kind of a baseline trend on all these things, which I think is important. As that information becomes available, I'm going to cover it right here. Have a great day, great week. If you have any questions on this or anything, please reach out to me. I'd love to help. Have a great day. Talk to you soon.